All right, I am back for a deep dive into CorVel Corporation. I wanted to start with this stock first because I have not seen a deep dive into this company. I haven't seen this company really talked about much. It actually popped up on one of my scanners months ago and then for some reason went off. But the more I dug into this company the last couple months, it looks extremely attractive, and especially just to, at least to start building a position in. As a reminder, I have a $1,600 or $1,700 portfolio. I just started last week, and my goal is to get to $100,000 in 5 years by the end of 2030. And I hope you'll take the journey with me and see if I can do it. That's about an 18% annual return, including the contributions. So CorVel is currently 13%. That all the stocks outside of Adobe, which is the highest, and then Toast, which I'll be buying on Monday, are at 13% right now. I'm just, again, it's an 8 stock or almost a 9 stock. It'll be a 9 stock portfolio with Toast. I could get up to 10 stocks. I'm probably going to shift around the weightings, as I start investing and stocks, go up or down or what have you. So these aren't set in stone at all. So anyways, deep dive into CorVel, actually really a 5-minute video because I'm doing this on my phone and I'm going to do probably a little bit deeper of a dive. But I just wanted to touch on this company high level because I think that it's not a screaming buy, but I think it's a quality compounder that grows revenues, earnings, cash flow, very, very consistently, doesn't buy back a lot of stock, could buy back a lot of stock, is owned significantly by insiders. I think it's 40% roughly. I'll look at that in a second. And it's a choke point of the economy. Again, that's one of my investing pillars, is to invest in companies that are toll booths, choke points. Chuck Hockery calls them toll booths, but where companies don't have a choice, so workers' compensation insurance, or workers' compensation is federally mandated. The demographics and the trends seem to be continued growth. Not only and just there's just such a strong need for CorVel to help companies manage risk too. That's really what they call themselves. So anyways, without further ado, CorVel Corporation, $215, a big whopping $215. That will grow over time. If I stay at 13%, I'll have $13,000 in this stock in 5 years. It could be more. I hope it's more. So CorVel Corporation, again, it's so under the radar. Been on the NASDAQ since 91. Obviously, it's not a gargantuan company, less than $1 billion in revenue. But I've really dug into this company the last 6 months or so, and I really like what I see. You have a company that, again, mainly provides worker compensation, risk management solutions. So they work for companies to help, basically when they have a workers' comp claim, a private company, let's say Target. I don't know if Target is one of their companies, but Target has an injured worker and they file workers' comp. Target uses CorVel to help manage that claim and be efficient, treat the person with respect, and adhere to all their rights under the workers' comp laws, all of that, but really help the company, Target that is, manage that claim and take that burden off of Target, and be, again, as efficient as possible. They also do work with the patients. They want to find the best care out there. So it's a really cool company, and again, it's a federally mandated program that's not going to go anywhere, and it continues to grow. And CorVel is such a small pie; they can they can continually increase their market share, which I think is why I'll get into the fundamentals of the company later, why I think that it's such a great company. So they also work with for property and casualty and health insurance as well. So just depending on the type of workers' comp claim, they dive into that sort of thing. So what I wanted to touch on here is this is just their investor page. You can do your own scrolling around. Gordon Clemens just announced his retirement. I think he retired earlier this year, the founder of the company. So they changed CEOs, but it's someone pretty well trusted. And I think that he's been there for a long time. Michael Combs. I need to dive into that on this video. But what I really like is, again, fundamentals, no debt. You'll see they have a good cash position. But they're 44% insider ownership, which I think is extremely high and extremely enticing, especially to see a stock down as much as it is this year, which I'll dive into again. So you can see they got several different resources for you to dive into. I'll touch on this a little bit. And what I really wanted to point out is, first of all, buying back shares, increasing revenue per share, increasing earning per share, return on equity, and ROIC are all going up. No debt. Really quality companies, a huge addressable market that they really have not tapped into fully. As you can see on their investor relations, they're really number 5. And you can see how they're really the 1,400 claims a year versus the top is 29,000. Even if they'd doubled that, or tripled that, they'd still be a small slice, but they would be significantly higher from here. So they're obviously doing something right. They're not really buying companies. They're growing organically, which I like. They have a really cool software program that you can dive into, which you can see here a little bit, that helps manage the claims, again, on the company side, the client side, but also the patient side. So I wanted to touch on fundamentals. So this year, or really, I guess this is a 1-year chart, but essentially all of 2025, they're down 30 or 40%. You can see they really peaked at about 130, and since then they have just cratered, and you have to ask yourself why. And I look at the 5-year chart, and I saw this same thing happen in 2022. This is a little more severe. And if you look at the max chart, it's a compounder. It has consistently grown its revenues. It has consistently outperformed the market. Obviously, it's been a huge winner over the long term. There have been significant dips. This is like the most oversold it's been in a long, long time. But usually, again, when you look at a chart like this, you're like, okay, last 5 years, or really last year, what have they been doing wrong? Well, I'll show you, and it's really nothing. Revenue, obviously, I wouldn't even say it's declining. You got negative 6% in fiscal 21. They hit 10% in 24. It's back to 10%. But again, it's a consistent double-digit revenue. Operating income continues to grow, actually pretty fast. If you ask me, net income, you can see, outside of a couple of years, you've got double digits, upwards, they're pushing 30% net income growth. They're barely buying back any shares. They did in 2022, which made sense. I think they will this year as well, if they aren't already this quarter. And then their earnings, what I really like is that the earnings are consistent. 43% growth, 16, 24, 28. Again, it's accelerating. So over the last year or two, as it has been completely cratering, their fundamentals have gotten better. Free cash flow as well. this was an interesting year. I'm still diving into this, what that dip was, but obviously 2022 wasn't a good year. But since then, I mean, that free cash flow is significant. They have great margins, very stable, and they're increasing as well, ever so slightly, but they're increasing. And I really like their free cash flow margin. So again, no debt. Cash position has been growing. They've been hoarding cash. Again, this is a small company. This is a $3.3 billion company. They have $207 million of cash on hand. So again, a decent amount and no debt. So what I really like is that their net cash is just, again, continuing to grow. They don't have debt. Again, so that puts them in a position of being able to take advantage of opportunities when they come up. Book value per share, I like to look at this, has been growing significantly as well. Cash flow statement, again, net income has been significantly increasing. Really low stock-based comp, which I love. Good operating cash flow. Again, here's the free cash flow growth. So outside of 2022, I mean, they've 59%, 49%, 25%, 30%, 38%. I mean, that is significant. That is so stable. And again, this is what the market's missing, I think. It's like and I'll get to the valuation. You can say that it's been overvalued for sure, but this is the kind of stock that I like to see, where the fundamentals are increasing and the stock price is decreasing. And as you can see, they haven't bought a whole lot of stock back, and I think that they're going to really ramp it up this year with all the free cash flow. So it's an expensive stock. PE ratio of 32. I don't think they really give projections, and not a lot of analysts cover it. But again, you can see it's growing their earnings at 25%. So you're really at a PEG ratio of about 1. It's almost growing its earnings at 30%. 3 price to sales, really amazing. Again, all the metrics are slightly expensive. I'm not gonna fight that, but it's a quality company. You can see the fundamentals have been rock solid, and it's discounted, significantly discounted. If you look at the PE ratio is lower than it was in 2022. You can see it's been low up until about 10 years ago, and then it started to kind of have multiple expansion. So I think they're about to turn a corner. What I really like is the increasing and stable return on invested capital and return on equity. So that's CorVel. I'm here. I am at 13 minutes, and I don't want to keep going and going. But you can, if you just scroll on any news site, there is nothing. It's all their own press releases, transcripts. There's a Benzinga article, which is rare, but it's all awards and things. I mean, even the last year when they went through a 3-for-1 stock split last year, there is nothing. There's no commentary on this company, and I can't believe that a quality compounder like this, there we go, is not talked about. I think that it's an incredible investment opportunity, at least to start a position. So that's what I'm doing. I'm going to build it over time. And I'm excited about it. I'm going to continue to watch it. I really want to watch on their execution, the continued free cash flow growth, earnings growth. And I like the earnings growth without buying back stock. Again, that's really similar to Copart, where you can grow without buying back stock, which artificially, or not artificially, it inflates the earnings per share. So I'd love to know your thoughts as well. I'm curious on who's heard of this company, and who's going to do a deeper dive. Again, this is my portfolio. This will be a 13% position in in my family fund. I do have this in one of my other retirement funds that I manage. It's about I think it's a 1.5% position, really small, but much bigger numbers. So that's that. Would love your thoughts and comments. Again, help the algorithm. You know what to do. again, if that actually works. And until next time, I think I'll do probably another kind of semi-deep dive. We'll call this a semi-deep dive into another company, probably Copart. I really like Copart, and I don't see a whole lot on that. And then maybe Sprouts Farmers Market as well. And then we'll see where things go from there. Thank you. Bye-bye.